Hello, my name is Sam Stovall, Chief Investment Strategist at CFRA Research, and we welcome you to today's quarterly webinar entitled Battling the Summertime Blues. With me today are Lindsay Bell, Vice President and Investment Strategist at CFRA, as well as Todd Rosenbluth, who is the Director, ETF and Mutual Fund Research. Today, the agenda is that we'll talk a little bit about who CFRA is. We will review the performances of the first half, then give our outlook for the second half, and then wrap things up with questions from the audience. Before we get started, however, let me remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar panel, and we will do our very best to answer as many of these questions as we can. But first, about CFRA, getting to know who we are. Obviously, our mission is to provide our subscribers with global, independent, and actionable research and analytics to help them make better investment and business decisions. The company started more than 20 years ago developing forensic accounting research and analytics that identifies public companies with deteriorating earnings quality. Added to that was, in 2016, independent equity research, as well as commentary that focuses on stocks, ETFs, mutual funds, sectors, and industries. Our clients are quite varied. CFRA is trusted by the most sophisticated global firms, ranging from asset managers to hedge funds, wealth managers, online brokers, and our services are used to support multiple investment strategies, primarily focused on equities in both the long and the short areas. Independence is our namesake. In a sense, research is all we do. CFRA does not manage money or make trades. Many independent research providers claim to be conflict-free, but actually are not. So enough of who we are. Now let's talk about what has happened over the past first 6 months of 2019 and discuss possibly why that happened, and then also what could that imply for the second half of 2019. In the first half of the year, the S&P 500 posted its 8th strongest 6-month return on a price basis since World War II. The S&P 500 gained 17.3%, just a shade above the S&P Mid-Cap 400, and a bit above the Small-Cap 600, which was still up nearly 13%. Globally, equities were up more than 15%, which was quite encouraging. All of the sectors but one in the S&P 500 gained double digits, but all 11 were up or positive on that 6-month basis. Not shown here, but equally impressive, was that more than 90% of the sub-industries within the S&P 500 and S&P 1500, which consists of large, mid, and small cap stocks, were in positive territory for the first 6 months of the year. I think one reason that investors were optimistic about the performance of the S&P 500, first off, is we started the year on a pretty low point because the S&P had bottomed on December 24th of 2018, having fallen almost 20% on a closing basis. So we started the year at a relatively low point, thought being that maybe the Fed had finished with its rate tightening program and, like 1995, may actually begin a rate easing program within the next 6 or 7 months. Reminding what happened in 1995, where the S&P was up 34% in that full calendar year, investors were also reminded of other periods in which we had the Fed initiate a new rate reduction cycle, and on average, in the 6 months after the first rate cut, the S&P 500 climbed more than 10% in price, and 12 months later, the S&P was up more than 14% in price. So investors were hoping that this could end up being an equally opportunistic period for equity investors.
Sam, just to add to that, so from an ETF perspective, we'll move here to this slide. You can see that U.S. equity investors were very favorable positioned. SPY we're using as the S&P 500 index ETF. On a total return basis, SPY was up nearly 20%, outperforming what we saw with developed equity strategies, IEFA from iShares, and emerging market strategy, IEMG. That's the one that's going to have exposure to China and Taiwan and South Korea. And you can see there was diversification benefits within fixed income, but taking on risk was rewarded. The high yield bond ETF HYG up roughly 10%, but the AG up 6%. Pretty good for certainly considering how well equity investors did. The lower half of this, you can see how smart beta oriented strategies have performed and performed in the first half of the year. A bit of an anomaly in that we saw a whole range of strategies perform almost in line or slightly better than the broader market growth using RPG, which is an Invesco product, and QUAL, which is a quality ETF from iShares, up more than 20%. The low or minimum volatility suite of products performed relatively well. USMV up 19% in the first half of the year. And again, value, even though people tend to view that value has been out of favor, 16% is a pretty good total return gain for RPV for a strategy that is out of favor. Value is underperformed, but is still, you'd be pretty pleased with a value strategy the first half of the year. But Sam, I guess what's ahead for the next 6 months?
Well, the next 6 months of the year, what we find.
Oh, actually, Sam, before I do that, apologies. I got ahead of us there. I was ready to hear your take on the second half of the market. But investors have been positioning for that second half of the year a bit more defensively. So we've seen consumer staple strategies and utility strategies in favor, despite the fact that they've underperformed in the first half of the year, the broader market. And technology has been an area that has been strong in the second quarter, erasing some of the outflows that we saw in the first quarter of the year. So we've really seen a combination of the cyclical sectors like discretionary and technology, and some of the defensive sectors, consumer staples and utilities that have been in favor. Healthcare has really been the outlier in the defensive sectors, where more than $3 billion of net outflows. So again, this is how investors were positioning heading into the second half of the year. Sam, now let me show you where we're going to go.
Thank you, Todd. Gee, I thought I was the only one who liked to hear my own voice. Anyway, the second half of the year. So with the very strong performance that we have seen, whether it's with the actual equity prices, or as Todd just mentioned, showing the ETF flows that occurred in the second quarter, what does that imply for the rest of this year? Actually, it implies pretty positive returns for the second half because of what happened in the first half. Starting with a look back to World War II, what we find is that in the first half, the market has gained an average of 4% in price, and that's looking at all 73 years from 2018 back, and then realizing that, okay, the market was up basically 2/3 of each year, so up 68% of the time. Second half had a similar performance, up an average of 4.1%, and again rose in price 68% of the time. When the first half was negative, however, the second half gained less than 2%, and we had 23 years in which that occurred. 57% of the time, the market was higher. So really, if the first half is down, chances are the second half, it'll be up but not by much. When the first half was positive, that is also very positive for the second half in general, with the market up a little more than 5%, rising in price almost 3 out of every 4 years. Yet it really gets good when the first half was up by double digits. In that case, we had that happen 20 times, and the S&P gained an average of 7.5% and was up 80% of the time. This is all fact. It's not a forecast. Basically, there's no guarantee that will happen again this time, but it does sort of make investors feel a bit encouraged that just because we had a strong first half does not mean we have to digest gains, give it all back, and that we have to sort of hunker down. On the contrary, momentum tends to beget additional momentum. But it doesn't necessarily mean that this higher momentum will occur right off the bat. Typically in the third quarter, we tend to have sort of weak performances. On average, the S&P 500 since World War II gained less than 1%, up 0.5% to be exact. It was the weakest performance of all 4 quarters. The batting average, the frequency with which the market rose in the third quarter, was only 59%, which was the weakest by far as compared with the fourth quarter, which saw an advance 78% of the time. The strongest third quarter performance was a gain of 15.9%, but that too was relatively weak, certainly as compared with the fourth quarter's 20.9 or even the first quarter's high water mark of 21.6. The worst performance again occurred in the third quarter with a 26% decline, and that does not fare well at all, certainly against the first quarter, which only had a decline of 12.1% at its worst showing going back to World War II. Finally, not surprising, the third quarter had the greatest amount of volatility, with the average quarterly standard deviation being 16.9 versus low water marks of 14.1 for both the first and the second quarters. Now, we did have a very strong start not only to the first half, but also to the first 4 months of the year. Year to date through the end of April, the S&P 500 was up 17.5%. That was the third best performance since World War II. And then history implied, well, maybe you have to be careful because May tends to be negative. Not shown on this chart, May historically was down 60% of the time for the top 5 performers, and this time around it was down as well. But then history said, well, don't worry, we will rebound in June. It's done so 100% of the time for the top 5, did so 80% of the time for the top 10 year-to-date performances through April since World War II, and 2019 was no different. We gained almost 7% in June of 2019. So now the outstanding question is, well, what does history imply will happen in the typically challenging remaining part of the sell in May period? As you know, sell in May period from May through October has gained only about 1.5% since World War II, whereas the November through April period has risen approximately 7% in that 6-month period. Well, history tells us that we probably should expect some disappointments, with the S&P having fallen 80% of the time in the top 5 and 60% of the time in the top 10 in this July through October period, posting average declines during both sets of observations, but again reminding us that it is simply a temporary disappointment because the November and December period, which normally was up 2.8% since World War II, rising 75% of the time, actually gained almost twice that amount in the top 10 year-to-date performances since World War II and rose in price 90% of the time. Again, not a forecast, but it does give us the impression that July through October might be a bit challenging. I like to say that it'll probably trace out the design on Charlie Brown's shirt, but then once we get through this period of uncertainty, then November and December will likely exhibit its more normal period of investor optimism. Right now, or I should say recently, we experienced an over-exuberance, if you will, or an overbought marketplace. This is an undulating chart showing the weekly percentage of sub-industries within the S&P 1500. And there are 146 sub-industries within this U.S. benchmark. And this chart shows how many of them are trading above their 10-week or 50-day moving averages. Well, as of a week ago, it was trading 91% of these sub-industries were above their 10-week moving averages, and the one standard deviation level is at 85%. So essentially, we got in an overbought situation based on the percentage of sub-industries above moving averages, implication being that we're probably going to have to digest some of these gains in the near term, go through that undulating period, July through October, before we then see a bounce as we typically do toward the latter part of the year. Now, what are some of the reasons? Why is it that the market could be a bit concerned? Well, first off, will the trade truce last? We did have at the G20 meeting what seemed like a truce between the U.S. and China on its trade discord, but nothing really has happened since then. So the question outstanding is, okay, well, what's going to happen? Who knows? Another question is, what is the typical market action following rate cuts? Well, traditionally what we find is that the S&P 500, even though on average it has risen 10.3%, 5 of the 16 rate easing cycles since World War II actually saw the market decline in the 6 months after the first rate cut. So while on average it's up 10.3%, 5 of the 16 times we were in negative territory, and 2 of those 5 times were the most recent periods in which the Fed was cutting interest rates, which was 2007 and 2001. And then next, earnings. As Lindsay will describe to us, earnings are right now projected to be pointing toward a recession, meaning 2 successive quarters of year-over-year declines in S&P 500 earnings growth. Why is that a concern? Well, I like to say that bull markets don't die of old age, they die of fright. And what they are most afraid of is recession. And 3 out of every 4 earnings recessions since World War II have morphed into economic recessions.
Yeah, the EPS recession definitely is a concern, Sam. I'm glad you mentioned it. And this chart here, what I wanted to do was show exactly what Sam spoke about. If you can see on the right-hand side, you see 2 quarters of declining earnings per share growth rates for the second quarter of 2019 and the third quarter of 2019. I'll dig into the second quarter a little bit later, but after this, you also notice that we're expected to see a rebound in earnings once we get through these tough quarters. Part of the reason why we're seeing such slower rates of growth in 2019 is because look at the substantial rates of growth that we saw throughout 2018. And of course, a lot of that had to do with the tax reform and deregulation packages that were passed through Congress at the end of 2017 and going into the beginning of the new year. That also led corporations to be incentivized to do heavy levels of buying back their stocks. We saw record levels of buybacks in 2018. You're continuing to see companies continue to buy back their stock, though those rates are starting to diminish a little bit. The last time that we saw earnings recession was in 2015 and 2016. You see that on the left-hand side of this bar chart. And at that time, similar to now, the market and investors were fearing a slowing growth environment globally. So you saw those earnings numbers come down. I'll get into this a little bit later, but energy prices also came down. The energy sector was a key driver in these declines that we saw then. But what does this all mean for the future? Well, more than likely, we're probably not going to see an earnings recession just based on historical trends of earnings estimates, the consensus estimates at the beginning of earnings season versus the end of earnings season. We definitely think we'll see positive growth at least in the second quarter here. So what that's going to look like for 2019 is right now the consensus estimate is looking for, a slight 1.7% increase in earnings growth, which is pretty weak when you think about what the stock market's been doing this year. The S&P 500 up, near 20% on a year-to-date basis. But that 1.7% earnings growth is coming after a 2018 that was just a blockbuster year, 23% earnings growth on an annual basis. In 2017, we saw 12% annual growth. So this is a massive slowdown. But in 2020, guess what? The consensus is looking for a major rebound to over 11% on an annual basis. And you can see that trend is expected to pick up in the fourth quarter of 2019 with a 5.8% increase. And then once we get into 2020, we get 8.4% in the first quarter, and very similar rates of growth to improving rates of growth above that into the final quarters of 2020. But I want to talk about the second quarter. I want to dig into this a little more deeply because right now we are in the midst of earnings season, and I want to dig into that 0.2 of a percentage point decline that we're looking at currently. 20% of the S&P 500 has reported earnings, okay? We're looking for a 2% decline in earnings growth going into the reporting period. So that was right before July 15th when Citigroup kicked off things by reporting their earnings results. So far, it's only been, just a little over a week. We're seeing 79% of the companies beat their consensus earnings estimates. Only 16% are missing the estimates. What you have seen historically in the past is that's about a 66, 67, 68% on average beat rate is what you see on the bottom line. So we're running ahead of that, which is a very good sign. Additionally, we're seeing sales beat 60% of the time. The companies that have reported are beating their sales estimate, which is a really high quality sign. But the expectations for the second quarter, as you see from this bar chart, is we're still expecting six sectors to report an earnings decline, led by materials and energy and utilities. Materials and energy are linked to a lot of different commodity prices that have been on the weaker side. So that's why you're seeing them drag down the index. So what we're seeing on the right-hand side of this chart is you've got financials, healthcare, communication services leading the way. And what I wanted to note was that the financials, that 8% earnings growth, is significantly better than where we started the earnings season. Almost about 45% of the financial sector have reported results so far. So we started with a 3.6% positive growth rate for that sector at the beginning of the reporting period. We're ending up with 8% so far. So that bodes well for the rest of the sectors. Healthcare, too, is coming in. They still have a long way to go. They have about, I think, 20% of their earnings have been reported. But we were looking for 2.1% at the start of the period, and now we're at 3.4%. I expect that to go probably decently higher from here. Industrials, consumer staples, eking out positive growth, too. What else I would point to? Technology, that 2.2% decline. Looking at that, that's the first negative quarter that sector has seen since the first quarter of 2016. So technology has seen robust growth over the last several years, and we're starting to see a little bit of a slowdown. Part of it has been really driven by the Chinese trade situation. But despite this declining in earnings, we're still seeing this sector leading the market. So we're going to want to see, as these companies report earnings, we're going to want to see some guidance, reassurance. We're starting to hear that the semis, which have been driving the weakness and which are at the start of this supply chain for a lot of these companies in different sectors as well, the weakness there is starting to improve. It's not as bad as feared. So that will be one sector I think will be very important to keep your eye on as the season progresses. So what does this all mean for the second half outlook? We don't think Q2 is going to end in negative territory. We think they're going to have positive growth. I should mention that usually you see earnings growth come in 4 to 4.5 percentage points better than the initial expectation. So in Q2, we can get anywhere from 2 to 2.5% positive growth when it's all said and done, in my opinion. But looking at third quarter and fourth quarter here, we've seen what this chart shows is where the consensus estimates were for each sector in the S&P 500 on June 1st and where they were yesterday morning. And then the difference between those two numbers. And you see both the third and fourth quarter numbers have been reduced by about 200 basis points or 2 percentage points, which is good. That's usually the typical behavior you see, but I would expect you to see more weakness on the outlook in both quarters. The third quarter is coming down nicely as uncertainties driving near-term outlook and driving consensus estimates lower here. But I think that, management teams have no incentive to really be courageous here. They're going to just be cautious, especially given the trade situation, what's happening, Brexit, and the rest of the world. So Q3 could get a little bit deeper into negative territory. You've seen some big cuts, like you can see here in the energy sector, industrial, materials. Those are the sectors you would expect to see be impacted by trade. We'll see what they say as they come out with their commentary and their earnings reports. Technology is one sector where I think that you might see some risk. Numbers have been cut. We're expecting a pretty negative 6.6% earnings growth rate in the third quarter there, but a rebound to positive 3.3% in the fourth quarter. Those numbers, I think, could be at risk. The fourth quarter overall for the S&P 500 is probably at risk. 5.8% positive growth can be considered a bit of an anomaly when you're seeing flattish growth for the first 2 to 3 quarters of the year. So keep an eye on what expectations are in the fourth quarter. Another area I already mentioned technology being at risk. I would also mention financials. That 15.7% growth rate for the fourth quarter looks to be a little bit, optimistic. Even though numbers, it's come down from 18.5% on June 1st. Given the sensitivity that the financial sector has to the economy and the consumer, it'll be important to keep an eye on that. There definitely could be risk there. So we talked a lot about the potential for an EPS recession. We didn't get into sales yet. And sales, again, this is a very important number. So I lined up the sales growth rates going back to 2014, just like I did with the earnings per share growth rates going back that far. You can very clearly see the sales recession that you also got in 2015 and 2016. 5 quarters of declining sales growth rates. And when your sales numbers are coming down, it's really much harder for your earnings numbers to move higher. So what we're seeing, though, encouragingly, is the opposite in latter part of 2019 and into 2020. You see these positive sales numbers. Of course, again, you're seeing a deceleration of what we saw in 2018, even 2017. But you still see mid-single-digit growth rate expectations. Leading the way in the second quarter is supposed to be healthcare, consumer discretionary, and technology. So again, healthcare, we didn't really touch on it too much, but that's one of the sectors too that starting to see good numbers that could get better as the sales numbers continue to go higher. So I don't have the annual numbers on this slide, but in 2018 we had about 8.6% top line growth. Well, this year that's going to decelerate to about 4.5% top line growth, and then again rebound in 2020 to 6.9%. So same trend in sales that you're seeing in earnings. When you think about sales, though, and top line growth, you really have to think about what the dollar is doing, because of almost 50% of the S&P 500 revenue comes from overseas. So there's going to be a major impact there. The dollar has been up about 5.6% year to date. A lot of people talk about the strength in the dollar. I think up 5.6% on a year-to-date basis isn't going to have that magnificent of an impact. But I think that it's something that you got to keep your eye on. We had a lot of consumer staple companies that have come out. They're a good one to watch with regards to the impact of the dollar, and they talked about their ability to offset some of the impact from the strength of the dollar by increasing prices. Also, offsetting any impact from tariffs, just reiterating how strong the consumer is. And so with that, I want to talk about actually the consumer discretionary sector, because this is an area, I talked about a lot of the different sectors where you might find risk within earnings. Consumer discretionary is one area where I think you might find opportunity. This lays out second quarter 2019 earnings growth rates year over year, you see the negative 4% decline consumer discretionary sector is expected to post. This is a sector that a lot of the companies, especially when you start thinking about retailers, that report later in the earnings season. So we won't hear from a lot of them until August. So I wanted to highlight these. This chart also shows the 4 industries that make up the consumer discretionary sector. Retailing includes Amazon. A lot of people forget that Amazon is a consumer discretionary company, not a tech company. And so the retailing industry, that 9.6% growth, largely driven by Amazon. You've got your department stores that continue to struggle in there, but then you also have your supermarkets and other stores in there that are doing better than some of the department stores. The consumer services sector, 9.4% earnings growth is expected in the second quarter. These are companies like your restaurants, your hotels, Marriott, Hilton, Starbucks, McDonald's, Royal Caribbean even. These are stocks that have done really well, and they're expected to reflect that in their earnings results for this quarter. On the flip side, you've got the autos and components, which you might as well just think of as your Ford and GM, and you're seeing deceleration in auto sales really driving a decline there. And then durable and apparel aren't expecting to show too much positive growth. I think you can maybe get a little bit better than that 8.2% decline, but really what's going to drive upside for consumer discretionary is going to be the consumer services and retailing sector. The consumer has been so strong this year. You're seeing wages rising, jobs are plentiful, consumer confidence still remains solid. Even though we're seeing weakness in the housing market, they remain optimistic about the outlook, and they're out there spending. One thing that is helping them is oil prices down 12% on average in the second quarter. That will certainly help a lot of these companies that benefit from the consumers who now have more room in their wallets, that not going to oil and can go to apparel and other things, or eating out, or experiences that they offer. Another key characteristic of the reporting season, again, the consumer discretionary sector is in very early stages. 19% of the sector has reported so far. 75% of the companies that have reported have beat on the top line, much better than what we're seeing for the overall S&P 500. On the bottom line, 83% of these companies, these consumer discretionary companies, are beating what the consensus estimate is. And again, that's ahead of what the S&P 500 has done. The reason I'm optimistic about the consumer discretionary sector is because the consumer staple sector has done such a good job with the companies that have come out. You're actually seeing companies raise guidance because on the back of the strength of the consumer. So I know consumer discretionary has outperformed this year, but I think it's got legs, as Sam said, momentum begets momentum. And so where do you invest? This next slide here shows some of the top ranked stocks in our consumer discretionary sector by CFRA individual analysts. The top 3 here, CarMax, Dollar General, and O'Reilly Automotive, are ranked with 5 stars, which is our highest ranking, and it means basically strong buy. We've got 4 stars on Amazon, McDonald's, Nike, TJX, Ross Stores, which is equivalent to a buy ranking. I think if you look at this page, and I kind of just handpicked some of these. We have other stocks too on our Market Scope Advisor that we encourage everyone to check out with 4-star rankings at least. Really, these 3 are the only 5 stars at this time. But I think what you're seeing in this group and the rest of the stocks that are ranked positively within the consumer discretionary is that they are, discount oriented. They have value offerings. The consumers, while they're still spending, they're being selective about what they're spending. And these are the people, the companies that are benefiting from it. The ones that are kind of on the losing end of the spectrum, the consumer discretionary spectrum, would be those brick and mortars like department stores. Also, those apparel manufacturers aren't doing as well either. So these are just some ideas. We encourage you to go to our Market Scope platform to check out more opportunities within the ETF space as well, Todd.
Yeah, what's interesting is some of the stocks that were on that list are what people would consider blue chip or quality stocks. So like Nike or Ross, those are examples of high quality stocks that you'd find within some of the ETFs we're showing here on the screen, such as QUAL. That's the iShares Edge MSCI USA Quality ETF. This is the larger of the two products we have on the screen here. It's also the more sector diversified. So technology, healthcare, financials are the three largest sectors, but you've got meaningful stakes in some other sectors as well. Companies that would show up in the top 10 and that we at CFRA are favorable on would include Apple or MasterCard, Pepsi, and Disney. 7 of the top 10 holdings are strong buy or buy recommended stocks. So ETFs, index-based ETFs, tend to be constructed based on a single characteristic or a couple of characteristics. This happens to be a quality one where balance sheet strength and financial strength is the focus, not valuation. But when we look inside the portfolio, we find a number of stocks that are attractively valued. This lower half of the slide is the Invesco S&P 500 Quality ETF, SPHQ. You can notice a few different things that are different about this. This has more of a focus on certain sectors, unintentional, but still, nonetheless, technology is more than 40% of the portfolio. There's just one stock in the financial sector that's 2% of the overall portfolio. The top 10 holdings comprise more than 40% of the assets. This slide is slightly stale because when we put this together, 9 of the top 10 holdings were strong buy or buy recommendations. Microsoft has been upgraded since then to a buy recommendation. So now all top 10 holdings that we have within our research are strong buy or buy recommendations. They cost the same, both 15 basis points. They're about the same total return this year, up about 22%. But if you look back only at, if you did analysis on ETFs solely based on past performance, you'd certainly see a 100 basis point differential between QUAL and SPHQ, highlighting the importance of looking inside the portfolio, which is the work that we at CFRA do with a holdings-based approach to rating ETFs. On the next slide here, we decided to take an even more defensive approach to this slide, focusing on higher dividend yielding ETFs. If we get the volatility that Sam talked about, if we do get earnings pressure, you would want to focus on dividend yielding stocks and for specifically companies that have above average yields. So VYM and HDV are two examples of that. I won't spend a whole time repeating myself about the differences between ETFs, but you can see the sector differences in particular. Energy is about a quarter of HDV. It's considerably smaller than that for the Vanguard product. In HDV, you'll find companies like Exxon and Chevron among the top 10 holdings, whereas VYM is going to have more financial exposure to companies like JP Morgan. Fees are nearly identical again, and the performance record is different, which is again why the research we have focuses on what's inside the portfolio, and we do that on a forward-looking basis. So I guess speaking forward-looking, Sam, what's ahead for the fourth quarter?
Well, Todd, as you know, when life gives me lemons, I try to make whiskey sour. So even though the third quarter is traditionally a bit challenging, and we've given reasons why there could be that kind of undulation of price over the next several months, I want to end on a positive note by reminding investors that the fourth quarter of years tend to be pretty strong. Shaded in blue, the first grouping is the average price change going back to 1990 for the sectors within the S&P 500. And you'll see that all 11 sectors were in positive territory. Real estate, granted, was started in 2001, but it too showed an increase of more than 1%. S&P 500 showing its best performance, up 4.3%, almost twice that of the first and second quarters on average. And where we see the most strength actually occurring in many of the cyclical sectors, in particular information technology, consumer discretionary, industrials, and to another extent, consumer staples. Taking that one step further, like Pavlov's dog, wanting to be reminded of the frequency with which a sector has risen in the fourth quarter, going back to 1990, while the S&P was up almost 8 out of every 10 years, we find that the leaders, again, were in the area such as consumer discretionary, up 83% of the time, staples up 83%, ditto with healthcare, but close behind at 79% of the time were financials as well as industrials, and then behind them tech and materials. So basically, when you've got sectors that have been rising anywhere from 3 out of every 4 years or better, and then seeing price performances that are pretty optimistic, especially after we have seen a very strong start to the year, implications are that 2019 will end up being a positive year. We just don't know the overall magnitude and how close it will come to replicating the last time that we had a rate rise morph into a rate cut within about a 6-month period. So with that, I will conclude the formal part of the presentation and then open it up for questions. As a reminder, if you would like to submit your questions, please go to the GoToWebinar panel, submit your question, and we will do our very best to answer as many of these questions as we can. But being the Boy Scout that I was, Lindsay, let me actually have some prepared questions for you. Let me ask you, what about the current valuation of the S&P 500? We've been seeing prices go up, surpass the 3,000 level on the S&P, yet we've been seeing the earnings actually sort of come in a little bit. Are we in dangerous territory when it comes to valuations?
Well, valuations are stretched from a historical perspective. So currently we're just under 18 times the S&P 500 on a forward price to earnings basis. And that compares to 16.4 times has been the historical average. So it sounds stretched, but as you know, we have to always take things into context. And with inflation being as low as it is and interest rates likely to move lower, the S&P 500 can withstand a higher multiple. So we wouldn't be surprised if the multiple expanded even into potentially, 20 times versus where we're at today. Of course, we'd like to see earnings really start to fulfill the expectations for the rebound to occur in 2020 to get more comfortable with that. But we're not in extremely alarming territory right now.
Okay. Well, taking that one step further, looking into 2020, I know we're expected to go from about a 1.7% increase to about an 11% gain for the full year. What do you think the driver will be? Will it be sales? Will it be profit margins?
Well, I think, like I said, sales are definitely going to rebound into 2020 from the slowdown that we're seeing here. Let me just get my exact numbers here. For 2019, we're looking for 4.6% top line growth, and that's going to improve to 6.9% in 2020, which is much more closer to the historical average. But it's not just top line growth. We love seeing top line growth because it's a high quality way to get to earnings growth. But we think that what the current consensus expectation is for when you look to 2020 is for margins to once again expand. In 2019, then we're looking for a little bit of compression as higher costs are baked into the system. So we peaked last year at, I think it was 15.3% margin in the third quarter of last year. We've come down a little bit from that. And, we're expected to stay in the mid-14, 14.5 range this year, but we'll rebound to expand to greater than 15% EBIT margins in 2020. So that'll be a driver. And then also, you'll have to remember that we expect that companies will continue to buy back their stocks which obviously helps juice the bottom line to some extent.
Okay, thank you. Todd, with the Fed likely to lower interest rates by the end of the month, how are investors using bond ETFs to position their portfolios ahead of this likely cut?
It's interesting. We've seen about $15 billion of money move into maturity-focused bond ETFs. We did in the month of May and June combined. So these are products that are exposed to either the short term or the short end, or taking on interest rate risk on the long end. Products like TLT, which is an iShares 20-year Treasury product, products like SHV, which is an ultra short-term product, are examples within the Treasury space. Interestingly, there's been little action thus far in the month of July. I guess investors have come to accept that there is going to be a rate cut of 25 basis points. That seems to be what's priced into the marketplace, and we haven't seen much action in July in terms of portfolio positioning. But we rate bond ETFs. We tend to talk about equities on these webinars, but we rate over 200 bond ETFs, and interest rate sensitivity is one of the metrics that we at CFRA are focusing on. And so if you check out the reports on TLT or SHV, those are good examples. You could be able to see how we're looking at the fixed income ETF world.
Taking this one step further, Todd, I mean, you talked to us about quality ETFs, you talked to us about high-yielding ETFs, sort of like the intersection of these two characteristics. What about companies or ETFs of companies that have regularly raised their dividends, so more dividend growth orientation rather than simply a high yield?
Yeah, and I actually welcome your take on this as well, but there's a couple of ETFs that are tied to the Dividend Aristocrats. These are companies within an S&P index that have a history of raising their dividends. So NOBL is a ProShares product tied to the S&P 500, companies that have raised their dividend for 25 plus years, and SDY, Sam David Yogurt, sorry, that's all I can come up with on that one, from a State Street product. These are S&P 1500 companies that have raised their dividend for 20 or more years. So there's obviously some overlap within there, but you'll get more of a small and mid-cap exposure to it. There's ETFs that are not tied to an S&P index like VIG, that were from Vanguard, that has a 10-year record of dividend growth. You obviously get benefits of companies that are raising their dividend year after year are doing so because they're financially strong and feel confident in their ability to do so. I know you've done some work on the Dividend Aristocrats as well.
Sure. Well, first off, with Noble, that is an equally weighted ETF, owning about 50 some odd stocks within the S&P 500 Dividend Aristocrat Index, as you described. SDY, the high yield Dividend Aristocrats, are companies from the large cap 500, mid cap 400, and small cap 600 that are weighted by yield. So the higher the yield, the greater the exposure within the high yield Dividend Aristocrats. And obviously there are, as you mentioned, a lot of others out there. I guess what I like about it is that if you are sort of a nervous Nelly and you want companies, you want exposure to the marketplace, but your focus is on quality, because these are companies, it's not just that they have raised dividends over one economic cycle or one stock market cycle, but rather if you're dealing 25 years, you're dealing with multiple economic cycles, multiple stock market cycles, as well as managerial cycles. So it's within the company's DNA to want to be increasing earnings and then sharing those earnings gains with shareholders. And probably even more important, as we continue with this longest bull market ever, and that is what's the possibility of a market decline, and how well do these dividend growers tend to hold up? Well, looking at the Dividend Aristocrats through our MarketScope Advisor platform, what I found was that the average beta or volatility versus the market was 10% less at 0.9 for those companies ranked A-, A+ in terms of the S&P earnings and dividend quality rankings. The low quality companies, those ranked C, or I should say B, B-, C, their betas were 1.2. So the philosophy being that if you lose less on the way down, you have less to make up when the market finally gets back to break even.
So one of the questions that came in, and this is, I'll throw this out for everybody on this in terms of where we see opportunities, both overseas and in the U.S. I'm the non-investment strategist here, so I'll turn it to the investment strategist as part of this. But overseas, Lindsay, I think our overseas team has a more favorable view on Asia than Europe. Is that correct?
That's right. We're actually neutral on Asia, but we were underweight Europe. We just moved less positive on Europe. So, we think the opportunity in Asia and emerging markets really is related to the U.S.'s intention to lower interest rates. That'll certainly benefit the countries over there. You're starting to see some of the stimulus, especially in China, start to flow through. Again, if the interest rates come down, the dollar comes down, that also benefits those guys over there. So, we definitely see some opportunity there. If you haven't had exposure, the markets are up pretty significantly year to date, but definitely think that they fell a lot harder and faster than the domestic market here and even Europe in the fourth quarter of last year. So certainly something to take a look at there. But I think, I saw the question also asked about different what sectors do you see the most value in. One sector that we're still hoping shows a little more strength, and this answers another question on the healthcare sector, is healthcare. We have an overweight ranking on that sector, and part of the reason we like that sector right now, and Sam can talk to this too, is in this seasonally weak period of summer, healthcare has historically outperformed, but also, when you start thinking about the third quarter and the volatility that he pointed to, healthcare can be a winner in the fourth quarter of last year when the market went into near bear market territory. Healthcare was the only sector that ended in positive territory. So this is just one sector that we continue to like. It's tough though, because on the flip side, you have the presidential election next year, and that sometimes this sector can bear the brunt of discussion within those debates and overall hurt the sector.
I'll just echo what Lindsay said. I mean, when you look at the rolling 5-year relative strength of total returns for the MSCI EAFE versus the S&P 500. So basically from 1975 to the present, looking at a rolling 5-year relative strength, the MSCI EAFE is trading at 1 standard deviation below the mean, so bouncing along an extremely oversold area. And it's not because earnings are expected to fall out of bed further than the weakness that we have already seen, because when you then use S&P Capital IQ to come up with a relative PE ratio for the S&P ex-US BMI, that means broad market index. Basically, developed international stocks are trading at relative PEs that are more than 1 standard deviation below the mean. So in a sense, investors are simply saying, we don't want to be anywhere near anything other than the US. The US is the only thing that seems to be working. But my feeling is that there eventually will come a reversion to the mean. And so if you currently own international holdings, then it's probably too late to bail out on them. To be self-serving, Todd, and you know this better than I, is that if you wanted to find out what areas of the globe to invest in, use the MarketScope Advisor ETF screener. Look for those international equity ETFs, and then look for those with performance analytics as well as risk considerations that are either market weight and or overweight, and you'll come up with a nice array of companies that I think a majority of which are found in Asia that have overweight recommendations because of the underlying prospects. We apply our buy, hold, and sell rankings to as many of the companies within each of the ETFs as we can, along with the S&P quality rankings, credit ratings, and so forth to come up with our overall investment outlooks.
And just to piggyback onto that, so we also take costs into account, and what we've seen is growing competition within the international equity ETF lineups that are out there. So we've seen JP Morgan enter with low-cost products. We've seen Franklin enter with low-cost products. So it used to be more of a premium to invest overseas than it has been in recent years. Sam, because I know that you have this at your fingertips, and I saw this question on this, obviously the election in 2020 coming up. Do we start to see an impact on that, or later on this year, the heading into the election year? Do we see anything if people are expecting a Democrat or a Republican?
Well, I've done this analysis for at least a decade, if not longer, is take a look at the market's performance from July 31 of the election year until October 31. That 3-month period, the market's performance will give you a good idea as to which party will be elected. If the market goes down from July 31 through October 31, then what happens is that the incumbent person or party has been replaced about 90+% of the time. As I wrote back on the Sector Watch report and our investment policy notes just prior to the 2016 election, we felt that the market was saying that there would be a Trump victory because the S&P had fallen in that July 31 through October 31 period. So history is a very good indicator, not a guarantee, but a very good indicator of how the market is feeling, and as a result, whether the incumbent will be reelected or replaced.
That's very interesting.
Very interesting.
And then maybe for the last question, someone asked, what do you attribute the length of the current bull market? Well, I guess everyone can weigh in, but Sam, I feel like you should.
Well, all right, the current length, I think first off is that we've had a very low interest rate, very low inflationary environment. So if you don't have a drag that you have to fight against, if you're not advancing in the face of a very stiff headwind, well, then you can last a lot longer. So inflation has been less of a concern. Interest rates have been very accommodative. Traditionally, interest rates have been about 1.5 above the year-on-year percent change in inflation, which would imply that the Fed funds should be closer to 3.5% rather than 2.5%, even after all of these rate increases. Also, the economy has not had any kind of jackrabbit starts. Normally, the first quarter within an economic expansion, GDP is up by 6%. Subsequent quarters, we see advances by 4+% before settling into a more normal trend of about 2.5%. Well, we've been at a 2.5% level since the very beginning. So it's almost like when I ran the 2 New York City marathons 800 years ago, start slow and then ease off. But basically, that's what the economy has done, is it started slow and it never really, on a full calendar year basis, accelerated to the point where it would run out of steam. So that's why our belief is that we cannot identify a recession in the near-term horizon, looking at economic figures, looking at as well as earnings results and so forth, that we still think that this bull market has several months to go.
Well, I'll take that as a cue, thanking everybody for tuning into this webinar and to promote the next webinar that Lindsay Bell and I are going to be a part of, along with a guest from Discretion, Dave Mazza, who's the Managing Director and Head of Product at Discretion. We're going to be touching on cyclical versus defensive investing. We'll recap the earnings season that Lindsay set up for where we're essentially 20% in. A lot of things are going to happen. We'll see whether or not we end up with a positive for earnings season, and whether the more cyclical oriented or the more defensive oriented sectors and individual stocks, individual companies are doing well. This will, of course, be, as you, from this coming from me, ahead of ETF research, this will be tied to ETFs so that you can get exposure to those sectors, what new tools that are out there. We really hope you join us for that webinar. You will see not only the link on the bottom of the screen, but you'll also receive an invitation following this webinar to get you started on that. And so with that, I really thank Sam and Lindsay for joining me, and thank you for listening in to this. Please tune into our next upcoming webinar and check out all the tools we have on MarketScope Advisor, where all of our research commentary is published, along with our great research team covering individual stocks. Thanks, and have a great day.